Hello friends, David here. Tesla, ticker symbol TSLA. I'm sure recently you heard of the news where Cathie Wood had a prediction for the stock price to be 3,000 by year 2025. And Elon Musk further confirming it by sending an email to his employees saying that 3,000 is indeed possible by year 2025 if they execute well. Is it going to reach the price target? In today's video, I'm going to share with you my calculation method on how I evaluate this business. If you're interested, please feel free to continue watching. For context, Elon Musk is saying it to motivate his employees. After all that's left is execution risk. If 4680 battery is able to scale, there's no telling the potential that it will reach. Energy sector and battery industry will be revolutionized. The phone battery that you're using for your iPhone battery, it may no longer be manufactured by Samsung or Panasonic, but instead by Tesla. EV cars will halve in cost, being cheaper than most petrol cars and able to travel 50% further. It will sell in the millions. And of course, there's also a battle of opinions between the conservative and the Tesla bulls on the price of Tesla. Conservative will say that this stock is overvalued, whereas Tesla bulls like Chicken Genius Singapore, someone whom I learned a lot from, will say that the potential is $4,000. So let me know your thoughts. What price do you think Tesla will reach in year 2025? To help you grasp some sense into this video, I'm going to share with you a DCF model to evaluate this business so that you can do your own calculation and form your own opinion about it. DCF is basically discounted cash flow model. Imagine your house as a business and you want to sell your house, but you're not sure how much to sell it for. Essentially, there are two methods. Number one, you look at the yearly income that this house generates and you predict that it's going to generate income for the next 30 years. So you combine all these 30 years income together and you apply a discount rate back to today's value. Why do you need to discount? Because what is worth $1 today is worth much less 30 years down the road. Think 1980. Back then, for $1 you can buy a whole set of lunch, but $1 today you cannot even buy a bottle of drinks. In Singapore, maybe yes, but not in Malaysia. And the second method is a relative model. Basically, you look at houses that are similar to yours in a similar location. How much are they selling for their multiple of yearly income? For example, if the houses that are similar to yours are selling for 20 times its yearly income, then you can be assured that you can also sell your house at a similar multiple. To illustrate further, let's deep dive into it. Now, before we further explain on the DCF method, let's have some assumption on the revenue first. In year 2026, I'm assuming a total revenue of 179 billion. This is consisting of US EV at 146 billion, assuming a 20% market share, China EV at 25 billion and FSD at 7 billion. What is FSD? It is called full self-driving. It's basically a subscription service you pay in order for the car to be able to drive autonomously. It's not full autonomy, but it's able to operate well under predefined conditions. Now, bear in mind I did not include all the other sector here, which is your energy, your licensing, your Starlink and so forth. I did not assume those revenue in to be conservative. So with a revenue of 179 billion, I'm assuming EBITDA of 31 billion, which is 17%. Now, you may be lost here. What is EBITDA? Let me explain. Imagine you sell a coffee business. You sell 10,000 cups of coffee at $1 each. Therefore, your revenue is 10,000. However, you still need to factor in the cost of goods, the cost of operation, such as buying your coffee beans, such as hiring staff or your rental. So say you after factor in those, you are left with $2,000. And this $2,000 is your EBITDA, earnings before interest, tax, depreciation and amortization. Basically, it's your earnings before factoring in those financial treatment. Interest and tax is quite easy to understand. Depreciation is like your capital expense. For example, you buy a coffee machine, but this coffee machine's value will depreciate over time. Amortization is something similar, but in intangible form, such as your intellectual property, goodwill, and so forth. Now, you may be wondering how I derive an EBITDA of 14% or for the FSD is actually 95%. This is based on their historical trend, and for this one, because it's a software, it has high margin. So on that basis, it has a margin of 17%. So this is how DCF works. First, you project the income that is going to come in future, and then you apply tax and other financial treatment to it, and you therefore derive the free cash flow. However, this cash flow is from the future and therefore you need to bring it back to today's value. And to do that, you need to apply what we call a discount rate. After you apply the discount rate, you have the discounted cash flow, and hence the name of this calculation method. And then what you do next is, you combine all your DCF over your projection years and you add a future component of your DCF beyond your years of projection. And this is your valuation of the business. So this is how we're going to calculate the DCF. We have established earlier that revenue would be 179 billion, EBITDA would be 30 billion. What you do next is you remove the D&A and you apply tax. Okay, so this EBIT is basically your operating income where you have removed the DA. So why do you need to remove DA before applying tax? Because it's not fair to tax a liability. So with the D&A excluded, you apply tax, and then after you apply tax, you add back the D&A amount. Okay, and then after that, you remove the capex, which is your capital expense, and that is your free cash flow. Okay, however, with this free cash flow, you still need to apply a discount rate to bring it back to present value. Why do you need to give a discount? Because if I give you 1,000 today, and you put it in a bank or invest in stock, you get much more than 1,000 in 5 years' time. Probably you get like 2,000 or 3,000. 1,000 today is worth a lot less 5 years into the future, and hence you need to reflect that. How do you determine the discount rate? Basically, you use a method called WACC. WACC is basically weighted average cost of capital, the cost to your capital every year. WACC is consisted of two components. Number one is debt, number second is equity. Debt is easy to understand, it's basically your interest rate. So imagine you borrow a house for a house loan, you're expected to pay 2% interest, that is the cost to your capital. And equity, because investors expect a certain return from you every year, you're expected to pay them, therefore it is also a cost to your capital. Combine these two elements together using a formula which I'm not going to share here, you have the WACC, or what we call the discount rate. Tech industry average is about 10%, but to be conservative, I apply 11%. And with the free cash flow, you apply a discount rate and therefore you bring it back to present value, which is your discounted cash flow. You combine all these 6 years of discounted cash flow and you add a future cash flow. Why? Because the business will continue beyond year 2026. And how do you determine the future cash flow? You use what we call a perpetual growth method. Perpetuity. This method is assuming that the business will run on forever and ever and giving you cash flow for infinity.
To infinity and beyond!
So the formula assumes a constant growth rate, and I'm not going to share with you the formula here, and that is how you derive at the terminal value, which is the combined future cash flow beyond year 2026. However, that terminal value, you still need to bring it back to today's term, and with this terminal value, you add back up all the discounted cash flow over your years of projection and you derive at the intrinsic value of the business. And further on, to determine the share price, you just take this intrinsic value, divide by the number of outstanding shares, and therefore you have the share price. Now you may ask, for the terminal value, why is it that if it's going to pay forever and ever, why is it that there's a finite value to it? Because imagine, in 10,000 years time, even if I pay you 10,000, that 10,000 in 10,000 years time is going to worth like say 10 cents in today's value. So therefore you will have a finite value because of the discount rate. For second method, it's quite straightforward. Basically you just take the earnings and multiply it by the number of years. If the multiple is 25, it means that you assume the business is worth 25 years of its yearly income. And then with the terminal value being determined, you apply a discount rate to bring it back to today's value. You less debt plus cash, therefore you have the market cap. And then you take the market cap and you divide by the number of outstanding shares, and this is what you're waiting for. This is the share price across different methods. For the perpetuity method is $200, and for the EBITDA multiple method is $400. Average it up, you have around $300. Now don't just leave yet, because I have one more scenario to share. It won't take more than a minute. However, if you want to leave, I respect your time. For the best case scenario, I'm assuming 501 billion with an EBITDA of 107 billion. This means that EBITDA margin would be 21%. In this assumption, I assume that EV sales will sell like crazy in both US and China, and I assume a portion of energy sector. Elon Musk said that energy sector is expected to have the same revenue size as their EV. But however, in this scenario, I'm only assuming 60%. Again, I still did not factor in robo-taxi and all the other potential future pipeline. With this assumption of revenue and EBITDA, using the perpetuity method, we have an intrinsic value of 1.5 trillion. And using the EBITDA multiple of 40, we have an intrinsic value of 2.5 trillion. This is the respective share price based on the best case scenario. However, bear in mind that Amazon and Apple is trading at PE ratio of 60 and 30 respectively, and these are companies that have already grown to a certain size. Their growth is not as fast, whereas Tesla is still at a fast growth rate. So to be apple to apple, because PE ratio uses EBIT, so I'm going to use EBIT instead of EBITDA, which is 89 billion here. I'm going to apply a multiple of 60 to be on par with Amazon. And this is 5 trillion. 5 trillion is basically 2,900 share price, which is close to 3,000. Why do I put multiple of 60? Because Tesla can't be selling cheaper than Amazon, right? Because Amazon has already reached a certain height, whereas Tesla is still growing. Therefore, it deserves a higher multiple. I hope you find value in today's video, and smash the like button if you like what you saw today. And do subscribe and hit the bell button. This will help with the YouTube channel. Wrapping up, it's always important to do your own due diligence so that you can evaluate the company on your own. This way you can work out your own assumption and develop your own price target for the company. If the price target is here, why do you need to worry about the short-term fluctuation here? No one can predict price movement in the short term, so don't try to time the market. Your probability of winning is always much higher with long-term investing. Dollar cost average throughout and let time do its work. So I hope you learned something today, and as always, invest safe.